What's up, everybody? Welcome back to the StockTrades.ca YouTube channel. Whether you're a new watcher or you've been here before, this is a channel where we go over Canadian stocks and Canadian stocks only. We also dive into a little bit of investment strategies and fundamental analysis. With a recent poll we've taken, you clearly just want to see more Canadian stock research. So that is definitely what we're going to bring you and what we're going to bring you this week. To go along with that, we asked you last week to comment on what your top telehealth companies are that you're looking at moving forward in 2020. We're running a contest where if you comment, we randomly pick a comment, and that person can comment this week down below with an individual stock they'd like us to produce a fully developed Stock Trades Premium report. That winner this week is Graham R. So Graham, drop a comment down below. Let us know what stock you want us to look into, and we'll deliver it and highlight it in next week's video. So what exactly are we going to be going over this week? Well, we're going to be speaking on 3 top Canadian financial companies that are A, poised to grow, and B, maintain their dividend through this unprecedented recession that we're already in and probably will continue to be in for some time now. These stocks have a history of maintaining their dividends through other market crashes and recessions, and they're also trading at some pretty low valuations. So you're not only going to see major Canadian banks in this video, you're going to see some, obviously they're the best stocks in the country, but we're going to be adding a mix of other financial companies as well. So with that being said, let's get started. So one thing before we get started, head down below, like the video, subscribe to the channel, but most importantly, drop your comment on your top financial stock you're looking at today, and even potentially what sector you want us to look at next. Our contest will run this week again. We'll pick a random comment and they'll get a full detailed research report from us over at Stock Trades Premium. This is pretty much less than 30 seconds worth of work for a research report with hours of material. So the first stock we're going to speak on, and one that is still trading well below its 2020 highs due to a fear of the recession and inevitably a housing crash, is Genworth MI. They trade under the ticker MIC on the TSX. In 2020, this stock is still down nearly 44%. Genworth has an extremely easy business model. Essentially what they do is sell mortgage insurance to people looking to buy homes. Now, the one interesting thing about this is I actually recently sold a home a year ago, and when we went to buy our new one, we had the 20% down. If you have more than 20%, you don't need mortgage insurance. If you have less than 20%, you need to get mortgage insurance through a company like Genworth. So we plan to put more than 20% down. But the reality of it was actually better to put less than 20% down and pay the mortgage insurance, because the bank was willing to offer us a significantly lower interest rate if we had our mortgage backed by a company like Genworth. So, we ended up paying thousands of dollars in mortgage insurance, but in the end, it's going to save us interest on our mortgage. And the reality of it is the vast majority of Canadians will never have 20% to put down on a home. Most homes will be backed by an insurance company like Genworth. So if we looked at Genworth's first quarter 2020 report, everything pretty much points to the company being in extremely good financial shape. We can see that premiums written of $114 million are actually up 8% year over year, although it was a pretty drastic drop quarter over quarter, considering in Q4 2019, they had written about $183 million in premiums. But the year over year growth is pretty strong. And if we see premiums earned, they've actually remained relatively steady. And if we look at the loss ratio, they've actually decreased their loss ratio year over year by 1%, and quarter over quarter, it's actually by 6%. So obviously, the lower the loss ratio, the better quality the portfolio. These mortgages are getting paid more often. Return on equity, we're seeing an increase in return on equity quarter over quarter and year over year, which is very good. And quarter over quarter earnings per share are actually up 4%. So the company states they have a book value per share of $39.61, and that's after a special dividend of $4.64 and $8.81 since the second quarter of 2019. So if we look at the average cost of homes here in Canada, the price is actually going up fairly significantly. In June 2019, the average cost of a home in Canada was around $505,931. Fast forward to last month, June 2020, and we're looking at a total home value of $538,831. This is a 6.5% year over year change. And considering Genworth makes their money off the purchase price of the house, the more real estate prices go up, the better off they are. So if we take this average home price and actually head over to Genworth's calculator to see what your premium would be, a purchase price of $538,831 requires at minimum a down payment of $28,883. What I'm trying to drive home is the fact that on a $538,000 purchase, if a Canadian has only the minimum down payment, you will pay to Genworth a total of $20,398 in terms of insurance fees. This is a significant premium, and as long as housing prices keep going up, Canadians will continue to struggle to find that money for a down payment, which, although unfortunate for Canadians, will ultimately help drive revenue for MIC. So before we get to the dividend, which is the most important thing about Genworth, let's have a look at their current valuation. The stock is currently trading at only 7.45 times earnings, 3.27 times sales, and 0.81 times book value. We already discussed book value in the investor presentation I just showed, but in terms of overall valuation, they're trading at a 21% discount to its 5-year average price to sales, a 16% discount to its 5-year average trailing price to earnings, and a 10% discount to its 5-year average forward price to earnings. So pretty much what I'm trying to say is Genworth, by all measures, is cheap. So as of filming, Genworth pays around a 6.4% dividend yield. And a dividend yield like this for most investors is going to cause them to look twice. A company yielding this high, there has to be something wrong. The payout ratio is too high. You know, a dividend cut is looming. They don't have enough money to pay the dividend. But with a payout ratio in terms of earnings of only 40.22%, and in terms of free cash flows, only 31%, this is a company that has lots of room left to grow. And over the last 11 years, they have consistently grown the dividend. Now, there are financial stocks in the sector that have faster growing dividends. Genworth has a 5-year dividend growth rate of around 7.5% annually, but it is also one of the highest yielders, and it has one of the lowest payout ratios in the sector. Genworth provides a little bit of a unique situation because we can expect the housing market to maintain strength moving forward in 2020 just because interest rates are low, but I still wouldn't expect this stock to shoot back up to its $60 range pre-COVID. But if low interest rates remain low going into the future, which they probably are going to, and housing sales maintain strength, Genworth should be able to maintain that dividend, and investors with a long-term philosophy have a very good chance of earning money in terms of share price as well. Let's move on to our next stock, which is a big bank, and that is the Royal Bank of Canada. So Royal Bank trades under the ticker RY on the TSX, and the company is essentially the most globally diversified bank here in Canada. If you look towards TD Bank, they'll have the most exposure south of the border in the United States, but in terms of globally, Royal Bank takes the cake. Now, that isn't to say that it has a low exposure to the Canadian economy. In fact, over 60% of its revenue still comes from here in Canada. It's just if you want global diversification, they are the bank you want to head to. Now, over the last 5 years, and this is including the price crash due to COVID-19, Royal Bank has returned around 39% to shareholders. This is just under 7% annually, including dividends. And in terms of a blue chip bank stock, this is pretty good, especially when we consider that the stock has taken a steep hit due to COVID-19. These numbers would be a lot higher if that hadn't happened. RBC has the highest market share in the country when it comes to things like personal banking, business loans, mutual funds, and overall deposits. They have a very dedicated customer base, a loyal customer base. There's a very good chance that if you talk to a Canadian that they bank at RBC. So in terms of earnings, it doesn't look pretty for Canadian banks, but it didn't in the 2008 financial crisis either, and all big five banks were able to maintain their dividend, and this is absolutely critical in today's crisis to keep their share price afloat. And the fact is, despite these numbers we're going to look at, the banks remain well capitalized and should be able to maintain dividend payments. In terms of net income, the company saw a 54% year-over-year decrease. Diluted earnings per share saw a 55% year-over-year decrease. The total provisions for credit losses exceeded $2.8 billion. And this is essentially money that the company will put aside to cover bad loans that they think won't get paid. Return on equity saw a significant hit, down from 17.5% last year to sit at 7.3%. But its CET ratio, 11.7%, remains well above regulatory requirements. And if you don't know, the CET ratio essentially compares a bank's capital against its current assets. Now, there is no question that all financial stocks, like insurance stocks, bank stocks, are going to struggle with interest rates this low. So generally, if you're looking for a company, you want to look for industry leaders. And we believe RBC is best in class. And a few of the reasons we think they're going to outperform moving forward is simply the fact that they can drive volume more than any other Canadian bank due to their sheer size. Like I stated before, they have a very loyal client base, they have the largest global exposure, and they are the biggest bank in the country here in Canada. Another reason is the fact that the company has less capital allocated to riskier sectors, so to speak. So with all that being said, if we look towards valuation, you'll see the points I just made are a prime reason why Royal Bank actually isn't even trading that much off its pre-COVID valuations. The company has a forward price to earnings of 10.92, which is essentially right in line with its 5-year averages. It has a price to sales of 3.16, which is a slight discount to its 5-year average, and a price to book of 1.67, which hasn't really budged that much. The stock is actually only down around 9.41% year to date. Now, in terms of dividend, the company yields around 4.5% right now at the time of filming, and it has one of the higher payout ratios in the financial sector, primarily among the big 5 banks. That's what we like to focus on in terms of payout ratios when comparing these banks, of 54%. Now, that is still a very safe payout ratio and a healthy yield. The company has raised dividends for 9 straight years, and the government has essentially stressed to Canadian banks to not raise their dividends. So we can expect that 9-year streak in which the company has raised dividends by around 7.5% on an annual basis to come to a stop. But in current market conditions, when companies are slashing dividends at rates we've never seen before, most investors would be more than happy with a maintained dividend right now. So the third and final stock we're going to talk about is one that often gets overlooked because it's not technically a big 5 bank. National Bank. They trade under the ticker NA.TO. So no, National Bank is not a big 5 bank, but if we look at this chart based on price growth over the last 10 years, they've definitely posted big returns. Over the past 10 years, a $10,000 investment in National Bank would have you sitting on around $21,190. Most all of the big 5 banks have somewhat of an established international presence, but with National Bank, that just isn't the case yet. In fact, less than 10% of National Bank's overall revenue comes from its international streams. For investors looking for a bank stock that they can invest in now and watch it grow over the next 10 years, National Bank is definitely one you want to keep an eye on. It's already outperformed the big 5 banks in terms of capital appreciation and stock price over the last decade, and because of the fact it has more untapped potential, it might continue to grow faster than these banks moving forward. And to add to that, it also does pay a dividend, and it actually yields around the same amount as most of the big 5 banks. So much like Royal Bank, if we look at National Bank's quarterly earnings, things do not look pretty right now. If we compare the second quarter in 2020 to the second quarter in 2019, net income is down around 32% and diluted earnings per share are down around 33%. Now, much like RBC, again, the company attributes most of this fall in net income to provisions in credit losses, which, like I said again, is money the company has to put away in case particular loans go unpaid. These loans can still be paid, and those provisions can eventually be added back into net income, but for right now, banks are being extremely cautious with the amount of money that they're setting aside for these provisions. Right now, a lot of these banks are desperately trying to help the government of Canada maintain the economy by deferring mortgages, deferring credit card interest, deferring line of credit interest, deferring even stuff like standard bank fees. And the fact that our banks are so well capitalized and are able to do this without, say, suspending a dividend should bode well for our economic recovery. So out of the 6 major banks here in Canada, over the last 10 years, National Bank has been the fastest growing bank, and we can probably expect them to be one of the fastest growing banks out of these 6 moving forward as well. But to add to that, the company actually has one of the fastest growing dividends as well out of these 6 banks. With a yield of around 4.5% at the time of filming and a payout ratio in the 46% range, National Bank has an excellent dividend. They've raised dividends by around 7.2% annually over the last 5 years, and their most recent increase of 9.2% was second in terms of dividend increases only to TD Bank. Now, although we won't see dividend raises, or at least it's very unlikely we see dividend raises from the big 6 banks here in Canada, it is very unlikely, although it's never impossible, that the dividends will get cut. Overall, I really like National Bank. Excellent dividend, excellent capital growth. In fact, it's outperformed the big 5 banks, but it does pose more risk than the big 5 banks just due to the fact it is smaller, it's centralized in Eastern Canada, although it does have exposure to most all provinces. Its primary generation of revenue will be from these 2 major provinces, and as such, if they struggle, the bank will struggle more than, say, a company like RBC, which has global exposure. But if you're looking for strong growth and a strong growing dividend, and you're willing to take on a little bit more risk, National Bank is definitely the best bet in the country. So everyone, that's pretty much it for the video. We've never done a video on the top financial stocks. We've spoken on a lot of Canadian dividend videos about financial stocks, but we've never really pinpointed our 3 favorite stocks in the financial sector right now. So again, make sure you comment down below. Graham won the ability to get a custom report from us with hours of research inside of it, and it took him 30 seconds to comment. So all you need to do, drop a comment down below. Let us know what your favorite financial stocks are. We're talking alternative lenders, insurance stocks, bank stocks, whatever it may be. We want to hear from you. And next week, we're going to highlight what company Graham wanted us to look at and announce a brand new winner. Till next time.